In recent months, Japan's financial strategy has caused waves in global markets with a particular focus on its substantial sell-off of US Treasuries. As the world's largest foreign holder of US government debt, Japan's decision to unload significant portions of its holdings has drawn attention, especially as this trend coincides with China's own divestment of American bonds. These actions are driven by Japan's urgent need to stabilize its currency, the yen, which has seen record depreciation. The question is, why now, and what does this mean for the future of global financial markets? Before we dive in, don't forget to like this video if you find it insightful and share your thoughts in the comments. Your support helps us bring more in-depth analysis like this to the forefront. The US Federal Reserve's aggressive interest rate hikes have triggered fluctuations in the bond market. Rising interest rates mean that existing US Treasuries lose value, which directly impacts foreign holders like Japan. This risk has been particularly evident in recent months as Japan's Treasury assets became less profitable and more exposed to market downturns. For foreign investors, including Japan, the depreciation of the US dollar relative to their own currency can drastically affect the value of US Treasury holdings. In Japan's case, the weakness of the yen against the dollar has made holding US Treasuries a more precarious investment, incentivizing its recent sell-off. Persistent inflation poses an additional challenge, reducing the real returns on treasuries. On top of that, geopolitical tensions such as US debt ceiling debates and shifts in international trade policy amplify the risks for foreign nations holding large reserves of US government bonds. Japan's decision to sell off substantial portions of its US Treasury holdings is largely a strategic move to stabilize its weakening currency. In May 2024 alone, Japan sold $59.5 billion worth of US debt, following $37.5 billion in April. The Bank of Japan has been forced into these aggressive sales to prevent the yen from depreciating further as its value reached multi-decade lows against the dollar. These moves are not just about currency management, they also signal a major shift in Japan's long-lasting financial strategy. For decades, Japan has been a significant buyer of US debt, using it to manage its foreign exchange reserves and stabilize its economy. However, as the yen weakens and inflation rises, maintaining such vast holdings of US Treasuries has become increasingly risky. Comment below if you think Japan's strategy will work in the long term. Do you think China will follow suit on a large scale? Japan's Treasury sell-off is already making waves in US financial markets. When a large holder like Japan divests, it pushes Treasury yields higher because bond prices fall as supply increases. Higher yields might sound good for some investors, but they also mean higher borrowing costs for the US government, which could exacerbate the country's debt burden. There are broader implications here too. As both Japan and China reduce their US Treasury holdings, we may see a global shift away from the dollar as the dominant reserve currency. This de-dollarization trend is fueled by rising US interest rates, inflation, and growing geopolitical tensions between major world powers. While Japan is divesting from US Treasuries, it's also making moves to invest more in domestic bonds. Rising yields on Japanese government bonds are becoming more appealing, especially as Japan moves away from its long-standing negative interest rate policy. This makes domestic assets more attractive and helps to shield Japan from external financial risks. The shift away from foreign bonds to local investments is partly driven by internal economic challenges. Japan is dealing with issues like stagflation and a rapidly aging population, and refocusing on domestic growth is essential for long-term stability. Japanese financial institutions, including major banks like Norinchokin, are diversifying their portfolio to reduce risks associated with foreign bond holdings. Japan's Treasury sell-off isn't just a problem for the US. It has the potential to create volatility in other global markets as well. As Japan reduces its exposure to US debt, it could spark similar moves by other countries, potentially causing a sell-off of treasuries in Europe or Asia. Rising bond yields in these regions could lead to increased borrowing costs for already indebted countries such as those in the Eurozone. Moreover, Japan's actions could further erode confidence in the US dollar's status as the world's primary reserve currency. If more countries follow Japan's lead, global reliance on the US dollar could diminish, leading to a seismic shift in how international trade and finance are conducted. With the US presidential election looming in 2024, trade relations between the US and Japan are in the spotlight. A change in administration could bring major shifts in trade policy, especially if a more protectionist leader like Donald Trump returns to office. This could strain economic relations between the two nations, particularly if tariffs or other restrictive measures are reintroduced. On the other hand, a more multilateral approach by Kamala Harris or another candidate would likely ease tensions and promote a stronger financial cooperation. Regardless of the election's outcome, the direction of US-Japan financial relations will be critical in shaping the future of both nations' economies. Japan's strategic divestment of US Treasuries signals a broader trend of financial recalibration. This move highlights the complex interplay between currency stabilization, bond market dynamics, and geopolitical risks. As Japan and other major economies like China continue to adjust their financial strategies, we could be witnessing the early stages of a global financial realignment. As always, if you found this breakdown helpful, hit the like button, subscribe for more insights into global economics, and ring the notification bell so you don't miss any updates. Thanks for watching.